So if I have to pick which banks to invest in, I will invest in Indian banks over the American banks. Hi everyone, welcome to today's video. So first and foremost, take a look at this particular chart and this will scare you. You will see that INR in comparison to US dollars has been constantly losing value. According to few of the forecasted estimates, it is estimated that INR will continue to lose 4% of its value every single year compared to US dollar at least till 2026. This is a very worrying sign. Many of you will think that, hey, INR is going to go to zero. It's time to sell everything and go to foreign markets. You will further get scared if I show you this data. So this data tells us FII selling in crores. And this is the month data for the month of March. So FIIs have sold roughly 44,000 crore of equities from the Indian market. And if you look at previous month's data also recently, again, it paints a very gloomy picture. So February, roughly 45,000 crore of FII selling happened. Then in January, 41,000, December, 35,000, November, 40,000, October, 25,000. So you'll say, okay, enough. I'm just going to sell everything in the Indian stock market and move to some other foreign markets. So should you be doing that and should you be worried about this situation? What is the sensible move that you must be making? This is precise discussion that we are going to have today. So on this video, I'm going to explain in very easy to understand language what dollarization of the world means and how India is getting impacted through dollarization of the world. Highly complicated macroeconomic video from that perspective, but I will keep the language very easy and beginner friendly. So please press the like button. It will help with the YouTube algorithm and I will deeply appreciate it. It would motivate me further to put in even more work and study in terms of making my videos. Second, we will understand whether or not you should be going outside the Indian market to invest, especially in this macroeconomic environment, and how you should go about developing that portfolio. So I will pick 1 lakh rupee as a sample portfolio size and I will tell you how you can go and design that portfolio and why. So let us get the discussion started. Point number 1, let us understand the story in the US because that will help us understand the concept of dollarization. So take a look at this particular chart. This shows the return in the decade from 2010 roughly to 2019. What you will see is different asset classes across the world have given different returns. For example, you can see that global equity, that if you consider all the equity investments in the world, they on an average have given 6.75% returns. Emerging market equity on the other hand have given negative returns over the decade. So India will fall in that emerging market, but Indian stock market returns have been generally positive. The entire emerging economies in total have given negative returns in the stock market because many emerging economies have somewhat failed, especially from a macro viewpoint. But if you consider this bucket, this is super interesting, right? You will see US mid-cap equities have given 11%, large cap have given 11.22, dividend paying equities 11.81, small cap have given 11.87. These are all US based equities. So the point is that US markets compared to other parts of the world have given very high returns in the last decade. Now, this data becomes extremely insightful from the point of view that if you think about what was happening in that period of 2010 to 2018-19, US and the world was in a rebuilding phase because 2008 financial crisis, where it happened in the US, and US had to undertake a lot of debt. How? By printing a lot of money. So that entire quantitative easing or printing of more US dollars started happening very aggressively in 2008. And that 2008 financial crisis, where did it originate? It originated in the US economy, and from 2008 onwards, US has been on a printing spree. So this is a chart for you which encapsulates that how much the public debt, this blue line, has gone up by. You can see a sudden spike here in this particular part. That means that US kept on printing more and more money, but their stock markets also kept on going up and gave US stock markets the best returns out there in the world. So which is like really crazy, and you will scratch your head that, you know what, if a government gets the power to print like infinite money, it can just skyrocket its own stock market when the other stock markets are falling. So this is the summary that we can draw so far based on the data that I have shown you. Now comes the interesting question as to why this phenomena played out. This is very important for us to understand, because if we understand this core concept, our knowledge of economic stock market just goes to another whole new level. So the concept lies in the dollarization of the world. Now, what do I mean by dollarization of the world? So dollarization in simple terms means that if the entire world starts using dollar and dollar becomes the apex or the prime currency, then that means that the world is getting more and more dollarized. So there will be occasions in the world when more countries are using US dollar and the strength of US dollar is growing. and that will lead to more positive dollarization of the world, and there will be circumstances when the dollarization of the world gets weakened. So I hope this basic concept about what dollarization means is clear. So with that viewpoint, let us understand the current circumstance as to where the world stands in terms of dollarization of the world. So this is a data that will help you understand this point in a slightly more intuitive manner. So this is the current data, and it categorically talks about the concept of reserve currency. So reserve currency simply means the world currency, that what is it that the world is banking on, which currency are they trading on. So the strength of US dollar is somewhat around 60%, that if the world uses 1 unit of currency, then 60% of it is used in US dollar. This is very, very big figure, because the next is euros, it's only 21%. The third is Japanese yen, it is used at 6%. So the US dollar right now is super strong. There is no problem with the US dollar, and it would be okay to say that the world even now is heavily dollarized. Now you might say that, okay, US dollar very strong, good for Joe Biden, good for Donald Trump, good for Elon Musk, all these people, why do I bother? I live in India, how does it matter to me? Okay, I will do India specific discussion also, but there are few key very important financial advantages that you have if your nation's currency is very, very strong, right? So let me explain that point in a very easy to understand language. So first and foremost, the primary advantage of your currency being the best currency or the apex currency is the concept of trust, because we work on a system called as the fiat money system. Fiat money system simply means that governments have the power to print infinite amount of currency. So every time the government prints currency, it is essentially giving a loan to itself. So it is giving more and more capital to itself. Now, when the trust gets eroded, when people think that, you know what, government has just done too much money printing and probably it will go bankrupt, so people will move away from that currency. There have been instances in countries like Zimbabwe which completely went haywire in terms of printing money. It printed so much currency, and there was no trust on the Zimbabwean government. So the entire economy got bankrupt. But if you are the apex currency, which is the US dollar, then this trust factor is very, 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 very high. You essentially de facto. So the word of the day today is de facto. Let me know what does that mean. So de facto, the US government can print a lot of money and give itself a lot of loan without taking a massive hit on the trust. Now this is a debatable point, and I'm simplifying this explanation for you, but this is what is happening from a practicality viewpoint. Why? I can again show you the data that, hey, from 2008 onwards, quantitative easing or money printing, it just increased in number to a very large extent. But despite that, the world did not lose trust on the US dollar, and we are sitting in 2022 and still US is the dominant currency. The second key advantage that an apex currency has is very simple, that under panic situations, for example, right now there is a panic situation that is playing out due to Russia-Ukraine crisis. In 2020, again, there was a panic situation. So whenever these type of panic situations happen in the world, the money flows to safe havens and safe currencies. So a lot of money from emerging economies like India have been pulled out. I showed you the FII data earlier. So a lot of money has been pulled out by FIIs. And where is it now? It is either invested in stable economies, or it has simply been converted into US dollar, and it's probably being simply kept in US dollars. Why? Because again, the trust factor that under panic circumstances, these stable economies will be the last one to go out and apex currency will be the last one to fall. This again can be understood from the fact that when 2020 COVID crisis hit, US printed money like crazy. But did India do that? No, because the trust on the Indian government from a world level, and please don't bring like nationalistic pride into it, from a world level, the trust on India is less compared to trust on the US. US is a safer haven, and whenever panic situation happens, the money will flow to the US and other stable economies. Now you might say, okay, fine, you have taught us so much macroeconomics, but tell me, how does it impact me as an Indian stock investor? Can you just simplify that? Okay, so two graphs I will show you. First and foremost, take a look at this particular chart, which we started the discussion with, and what does this mean? So essentially, whenever you see this type of chart that, hey, INR is going down, it means two things. One is that there is an impact on FIIs, foreign institutional investor. It simply tells FII or foreign institutional investors, these are big fat investors sitting outside India, it tells them that, you know what, INR is weaker, it's cheaper. You can invest your US dollar at a cheaper rate in India. So a lot of FII's money should technically flow into it. So whenever the INR weakens, it's an opportunity for FII players to invest more of their US dollars into Indian equities. So let's imagine this, that in 2010, one US dollar was 50 rupees. So with one US dollar, you could buy 50 rupees very, very easily or invest 50 rupees. So foreign institutional investor, if they invest in the Indian market, They will just simply convert one of their USD into 50 rupees. Now by 2022, if this one USD becomes 75 Indian rupees, then can these foreign institutional investors invest more in the Indian equities? The answer is yes, because the INR here has weakened. It has become cheaper. So anytime you see such a graph, it simply means that foreign institutional investors has more incentive to invest in the Indian economy because they are getting things for cheap. So this is the first key point. Now you will say that, you know what, I am not a big fat player sitting in Switzerland or US and all these countries. I am a humble domestic investor. So how does this falling rupee impacts me? Okay, so no good news there. If you are a domestic institutional investor or a normal retail investor who is earning in INR, then unfortunately you are losing your money at a global scale. For example, by next year, INR will fall by 4 more %. That is what predictions tells us. So if you are investing in Indian companies, your INR gets stuck with those companies, and technically you are losing 4% of its value every year because INR is getting cheaper and cheaper. If you would have simply put that money in the US market, you get invested in US dollar. So that does not fall. That rather strengthens compared to INR. So you benefit from it. So this is the first key implication that you must understand. But that is not the only impact of a falling rupee. There is another impact, and take a look at this particular chart, and there are two key impacts that will come out of it. So you can clearly see from this chart that India is a net importer country because our total exports are this and our total imports are this, right? And a very large segment of this import happens in oil, and oil is traded in US dollars. So every time India has to undertake oil import, it has to buy US dollars and then pay other countries in terms of importing oil. So if US dollar is getting more and more strengthened and we have to buy a lot of oil, it becomes a problem for us as an economy. And this is the current crisis that we are also facing because oil prices are very high and INR is also falling. So it's a double whammy or double problem for us. But just to help you simplify this, there are two key things that you must understand, that whenever the INR falls, and if you are an exporter of Indian goods and services, you will benefit. So if you're an exporter running an export shop, you are making saris in India and sending it to US, China, Russia, wherever, then you are a net benefiter in case the INR falls. On the flip side, if you are a company that is a net importer in India of things, it becomes a headache for you. If you depend a lot on external supply chain, it becomes a headache for you, and net everything will become costly for you. Now, estimating the impact of a falling rupee and discussing all its scenarios is a highly complicated task, and I cannot do it with one single video. But the point that I want to outline is this, that number one, whenever you see charts like these, falling Indian rupee, it does not mean the end of the Indian economy or the INR is going to go to zero. That is not the correct representation because there are a lot of parties that will benefit. For example, FIIs will benefit, DIIs will not benefit. Similarly, exporters will benefit, importers will not benefit. So it's a pro and con game. It's not as if that falling Indian rupee is a bad situation for the Indian economy. Yes, it should stabilize in a particular range. That's the goal, and that is where the RBI and the Indian government comes into the equation and they balance it out. So we need to leave that decision to them. But what is it that we should be thinking about in terms of being a stock investor? So there are two key points that we need to remember as investors. One, from a long-term point of view, that if the INR is falling and INR's value is falling, then a lot of FIIs have more incentive to come to the Indian market. But this will only happen if the Indian economy is strong. So the major part is that the Indian economy should be strong. Whether the INR falls or whether it rises, that's a secondary issue. But yes, if the INR falls, plus the Indian economy is very, very strong, then FIIs will enter the Indian market and your money that is invested in the Indian equities will grow exponentially. So this is the first key major point that you and I as retail investors should remember. Second is the short-term perspective. So in the short term, it is almost guaranteed that INR is going to lose 4% of its value. So if you are stuck only in Indian equities, it will be a problem area for you because you have invested everything in the Indian market. Indian economy is not growing. Plus the currency in which you have invested in, it is also falling. So it becomes a nightmare situation for Indian investors from that perspective, from a short-term viewpoint. So this brings us to the final question that, okay, what is it that I should be doing? So there are 4 specific points that I will leave you with. So first and foremost, should you be investing outside India in the short term? The answer is yes. You should definitely be investing outside India because that short-term risk in India is very, very high, and that is one of the primary reasons also why FII sold so much stuff. I am not trying to paint a negative picture about India. I am bullish about India. Majority of my investments are also in India. But having said this, I also invest in cryptos and I also invest in US stocks. Why? Because I need to balance that INR deflation, and any sensible investor should be doing the same. It does not mean that I'm not bullish about the Indian economy. I'm very, very bullish about the Indian economy, but at the same time, I need to hedge my portfolio by being diversified. So this is the first key point. Second key point, that, okay, where is it that you should be investing in? So you should be investing in strong economies or economies that can become strong with time. For example, if for some reason you are invested in Russia, please pull out your money. Please don't be an investor there. It might not be very useful as of now. If you are invested in India, it's a great economy. There are no fundamental problems in India. There is short-term pain, no doubt about that. But long-term, the bullish perspective is intact. In the US, the economy is very, very strong still. The quantitative easing, high debt, nothing matters as long as the US is the reserve currency of the world. So US is a very good market to invest. So as long as you can understand the businesses fundamentally in the US, please go and invest, no problem there. Number 3, you must understand that if you are investing outside India, what type of companies to invest in. So let me paint a picture for you, and this is a chart how Russia moved to alternate payment systems where they do not have to use the US dollar, and you can see a sudden dip from 2018 onwards, because yes, the war blew out in 2022, but Russia has been moving away from using US dollar from 2018 onwards, and you can clearly see that the share of American dollars in terms of Russian purchases has gone down considerably. Now if other countries also start doing the same, this is a major change in the dollarization of the world economy. This is important. Now you might assume that, okay, you know what, almost all the countries are going to move away from the US dollar. No, that is not going to happen so soon. Russia is trying to do it, China is trying to do it, but the rest of the world depends quite heavily on the US and US dollars. So it is not going away anytime soon, but there will be short-term implications on the type of US companies that you should be purchasing. For example, I am not an investor in US based banking system as of now. I have not purchased one single stock in US based banks. Why? Because this short term moving away from US dollar is going to impact the US banks first, because they have a lot of positions in terms of buying derivatives, investing in the Russian economy. They will have to pull out their investment. So there might be a lot of short term pain for US equities which are banking based. So I'm not investing my money in those. So if I'm bullish about the banking system, I would rather invest my money in Indian banking system, because think about it this way, that if Russia moves away from dollars, will it impact Indian bank? Is there any direct impact? The answer is no. So if I have to pick which banks to invest in, I will invest in Indian banks over the American banks. So which brings me to the final point of our conversation for today, which is that if I have to invest 1 lakh rupee outside India, what type of companies will I pick? Why will I pick them? And how will I do the asset allocation? So asset allocation, I've created a specific vest on Vested, so you can go and check it out. I will not speak about the numbers here. I will simply speak about the companies. So I will not invest quite heavily in cash flow or FMCG based businesses in the US, because I would rather invest that money in the Indian market, because Indian market is domestic consumption led. Make in India is very easy to do in the FMCG space. So if I'm taking some positions in companies like Walmart, I would not do it in the US. I would rather invest that money in Indian FMCG companies, even if they are global, but doing businesses in India. So that is the first key point. I would invest in the US in something like global tech. Why is that? There are multiple reasons for it. First and foremost, if you consider examples of something like Amazon, they do not face supply chain disruption just because Russia is doing something. They can move their servers very easily. I'm not saying that they will have zero impact, but the impact on their supply chain is going to be very, very limited. It is not as if their business will get ruined. They will go start new products in American economy, bunch of other different countries. It's not as if that they're importing a lot of stuff, all that stuff. More importantly, companies like Amazon, Google, they are sitting on massive cash, massive cash, and guess in which currency do they keep that cash? They keep that cash in US dollars. So if you have to take advantage of US being the apex currency, you can go and invest in these type of companies because they are cash rich businesses. If the businesses grow, if their investment grows, if they are handling their money well, then automatically there are multiple benefits to be reaped by the dollarization of the world by investing in such businesses. So I will invest almost 50,000 or 50% of my amount in companies like Amazon or Google. That's point one, because they have very, very limited exposure to de-dollarization of the world. Plus they benefit a lot by the dollarization of the world. Second key point, 50% of my money I will invest in emerging techs. These will be companies like UiPath, Shopify, and bunch of other different emerging techs that can become market leaders. Why? Because they become like a great acquisition target by companies like Amazon or Google. Whenever these type of acquisitions take place, they mostly go for a premium. So you get a lot of returns as stock investors, and all these major tech companies, Amazon, Google, they are on an aggressive spree to acquire these type of companies. So these are the two broad investment categories that I will pick right now in terms of making investment in the US. They are not exposed to supply chain disruptions. They benefit from dollarization of the world, and they are not impacted by de-dollarization of the world. I will keep on updating this West in case I'm buying new stuff. So check out the links in the description box. I hope you enjoyed the video. Please give it a thumbs up and I will see you tomorrow.